You expect glass. You expect a lobby with a security desk and a name etched into stone, because that's what $2 billion is supposed to look like when it finally lets you in the door. What you get is a strip mall. Your name is Wes Kovak. You own one commercial laundry outside Toledo, you wash sheets and gowns for 4 nursing homes, and you are driving a truck with 190,000 miles on it to meet a man named Hal Brannon. The address he gave you sits between a vape shop and a nail salon. The parking lot has a pothole deep enough that you slow down for it, and nobody has bothered to fix it, and nobody is going to. The door says nothing. No logo, no suite number, just a door. Inside, there are 4 people. A woman on the phone about a Nebraska warehouse. A man at a monitor with a spreadsheet so wide it wraps twice. A coffee maker from roughly 2009, and Hal, 61, in a golf shirt, who shakes your hand and does not offer you anything to drink. Hal Brannon runs $2 billion out of this room. Not for investors, not for clients. For one family, his family, and that distinction is the entire reason you are standing here and the entire reason you don't understand any of it yet. You ask him the obvious thing, why here? And Hal says the sentence that will follow you for the next 20 years. A family office isn't a building, he says. It isn't a brand. It's just the moment your money gets big enough that it needs its own employees. Then he asks what you're worth. 0. Not poor, 0. You have a laundry that grosses $41,000 a month, a payroll that eats most of it, a bank loan against the boilers, and a truck. That's the whole picture. Hal nods like that's the correct place to be standing. Because what's between you and this room isn't work. It's doors. 8 of them. And every single one only opens at a specific number. Not a good year, not a big idea, a number, and each one changes what you are legally allowed to be sold, allowed to own, and allowed to become. Level 1 starts today. And you're going to hate it. Level 1, $0. You don't have a company. You have a job that's wearing a company costume. Here's your life. The plant opens at 4 a.m. because the nursing homes want clean linen on the floor by 7, which means the drivers roll at 4:15, which means you are there at 3:50 with a thermos. 4 washer extractors, 2 dryers, 1 steam boiler that you personally know the sound of when it's about to fail. Revenue is $41,000 a month. After payroll, gas, chemicals, and the note on the boiler, you clear something between $6,000 and $9,000, depending on whether the compressor behaves. And here's the part nobody says out loud. You are inside every single dollar of that. You call the nursing home when a delivery is short. You fix the schedule when Della Marie calls off. You are the sales department, the HR department, and the emergency plumber. If you get the flu, revenue gets the flu? Hal has a test for this. He asks it the way a doctor asks where it hurts. If you disappeared for 30 days, he says, what would the number do? You do the math standing in his parking lot, and the answer is ugly. 30 days, without you, and you lose 2 of the 4 contracts, because contract renewal is a relationship, and the relationship is you. The number doesn't dip. The number dies. So the business isn't an asset. It's a job with extra paperwork and personal liability. An asset keeps producing when you walk away. Yours stops the second you stop looking at it, which means you can never sell it for anything close to what it feels like it's worth, because nobody buys a company whose only real employee is leaving with the check. There is exactly one move at level 1, and everyone gets it wrong. You hire the operator before you feel ready, not when it's comfortable. It will never be comfortable. You hire Ramon Ferreter, 22 years running plants like yours, wants $78,000 a year plus a bonus tied to on-time delivery. You go from clearing $8,000 a month to clearing $1,500. It feels like a demotion you're paying for, but every level above this one requires capital that doesn't need you in the room. And you cannot build that while you're the boiler guy. You're not buying help, you're buying back your own hours. Level 2, $250,000. The shoebox stage. It takes 3 years. Ramon runs the plant better than you did. On-time delivery goes from 91% to 98.6%. You add a 5th nursing home and a rehab hospital, and revenue crawls from $41,000 a month to $96,000. You stop being in the building. You start being on the phone. And one Tuesday you log into the business checking account and there is $250,000 sitting in it. You have never seen that number before. And for about 6 weeks you are the most dangerous version of yourself that has ever existed because you feel rich and you are actually fragile. Here is what $250,000 in a business checking account really is. It's 1 lawsuit. It's 1 $60,000 boiler replacement and 1 nursing home chain going bankrupt owing you $38,000. It earns nothing. The bank pays you 0.01% and thanks you for your business. And it sits in the same account payroll runs out of, which means it isn't savings. It's payroll that hasn't happened yet. This is where almost everybody torches it. They upgrade their life instead of their balance sheet. The truck with 190,000 miles becomes a 71,000 truck. The watch appears. And the one that kills people at exactly this level, they buy a second location on a hunch and find out the first one worked because of Ramon, and there's only one Ramon. You don't do that. You do the boring thing and nobody claps. You separate the money from the operator. The laundry goes into its own LLC, equipment, leases, contracts, and all the legal exposure that comes with driving trucks and washing biohazard linen. Above it sits a holding company that owns the LLC and nothing else risky. Cash gets swept up to the holdco. When the laundry gets sued, and eventually it does, a driver, an intersection, a 210,000 claim. The money is not in the room where the lawsuit is happening. Then you make the cash do a job. A T-bill ladder and a money market account, 4-week and 13-week rungs, so something is always maturing and the pile earns instead of decaying. At 5%, 250,000 pays you 12,500 a year to exist. That's not wealth, that's a signal. And you open a 150,000 line of credit against the receivables and never touch it. You get credit when you don't need it, because that's the only time anyone offers it. Nothing about this year is exciting, but something changed. Money stopped being income and started being capital. Income is what you spend. Capital is what gets sent to work. And capital is the only thing the next door will even talk to. Level 3, $1 million. The first door. There's no phone call. You're at the kitchen table with a legal pad adding up the holdco cash, the T-bills, the equipment, a conservative number for what the laundry would actually sell for, minus the boiler note and the truck loan, and the total comes to $1,040,000. You add it twice, then you sit there in the quiet. And somewhere in a database you have never seen, you have just changed categories. The rule is real, and it's narrower than people think. Accredited investor, $1 million in net worth, excluding the value of your primary residence. Or $200,000 a year in income, $300,000 jointly with a spouse, for the last 2 years, with a reasonable expectation of the same this year. That's it. That's the whole gate. It doesn't ask if you're smart. It doesn't ask if you know what a capital call is. It measures one thing and one thing only, how much you can afford to lose. Because that's what accreditation actually is. It is not a certification. It's the government stepping back and saying, this one can absorb the hit, stop protecting him. And what opens is the entire private market, Red D private placements, private funds, real estate syndications, private credit, operating company deals, the paper that is never advertised, because legally it can't be sold to people like the person you were 18 months ago. Within 6 weeks, the phone starts ringing. And here's what Hal warns you about, which you ignore, because everyone ignores it. The first deals you get shown at $1 million are the worst deals in the market. Not sometimes, structurally. Good deals are oversubscribed by people who have done 4 of them before. A genuinely good deal has a waiting list. It does not need to find a laundry owner in Ohio who has never seen a private placement memorandum in his life. If a deal is looking for you, ask what it already tried. So you buy one. A self-storage development fund in a Tennessee exurb, run by a guy named Torin with a very good deck and a projected 22% internal rate of return. You put in $75,000, 28 months later, entitlement problems, a lawsuit with the county, capital calls you declined to fund, and a letter informing you your interest has been diluted to nearly nothing. You get $15,000 back. You lose $60,000. You tell Hal, half expecting him to be disappointed. He isn't. He says the tuition was cheap, and then he gives you the sentence you'll repeat for the rest of your life. Accreditation isn't a reward, Wes. It's permission to lose money in brand new ways. Level 4. The $5 million door. This one takes 7 years, and the 7 years are extremely boring, which is the only reason they work. You buy a second laundry in Sandusky. The owner is 74 and his kids don't want it. $1.9 million for a business doing $2.4 million a year. Then a linen route, the trucks and the contracts and the racks for $640,000 because you noticed the route was the actual moat and the washing was just a part with the machines in it. Ramon trains a plant manager named Odalis who turns out to be better than Ramon. Revenue across the group crosses $9 million. None of this is a story anyone wants to hear at a party. And then the accountant sends the year-end, and your investable assets, not the buildings, not the business itself, the actual invested capital sitting above the operating companies, cross $5 million. Second door, different lock. Qualified purchaser, $5 million or more in investments. And that word does a lot of work. Your primary residence doesn't count. Neither does the business you operate. The laundry group, the thing that made all the money, is specifically not part of this number. The rule wants to know what you've got in the market, not in the driveway or the plant. What's behind that door is a category of fund most people will never be shown. If you're merely accredited, you get 3 SWAIF 1 funds. Those cap out at 99 investors. 99, which means every seat is expensive, so the manager fills them with the largest checks he can find, and yours is not one of them. But 3, 6, 7 funds are open only to qualified purchasers, and because everyone in the room clears 5 million, the fund doesn't ration seats the same way. That's where the managers who don't want retail money live. That's where we're not taking new capital comes from. You are now allowed in the room where the money doesn't need you. And you walk in, look around, and mostly don't buy anything. Because a fund charges 2% a year and 20% of the upside to go find businesses with predictable cash flow and boring customers. You own 2 of those. You are the thing the fund is looking for. Chase Dunleavy does not agree. Chase is 39, has roughly the same net worth as you, and holds nearly all of it in one margin account. Over a 19 beer, he tells you warmly like a friend that you're moving too slow, that you've spent a decade compounding laundry while he's up 60% since March. He's right about the 60%. He's just describing a coin that hasn't landed yet. Level 5, $25 million. You rent a family office before you own one. By now, there are 6 plants. You bought a competitor in Fort Wayne out of a bad divorce. The group does $34 million a year. You are worth a little over $25 million on paper, and you have not touched a washer extractor in 11 years. And your financial life has quietly become a disaster. Not the money. The money's fine. The coordination is the disaster. Your CPA is doing something with depreciation your estate attorney doesn't know about. Your estate attorney drafted a trust naming an entity your banker has never heard of. Your banker wants one consolidated statement, and you keep sending him 7 PDFs from 4 institutions. You are the only integration layer, and you are not qualified to be it. $25 to $50 million is where the multifamily office starts taking your call. An MFO is a family office you share. One team, investment, tax, estate, reporting, bill pay, spread across maybe 30 households. Institutional-grade infrastructure without institutional-grade salaries because you're splitting them with 29 other people who also own something unglamorous in the Midwest. And it costs, generally, between 0.50% and 2.00% of assets under management every year. Sit with that. At $25 million, that's $125,000 a year at the low end, $500,000 at the high end. Forever. Whether they beat the market, match it, or lose to it by 4 points. It is not a fee for performance. It is a fee that compounds against you exactly the way your money compounds for you, just quieter, pointed the other direction. You negotiate down to 0.85%. That's $212,500 a year to a firm called Wes and Ames. And you have to make peace with something Hal tells you when you ask whether it's worth it. You're not buying returns, he says. You're buying one entity whose job is to make the CPA, the estate attorney, and the bank stop contradicting each other in writing. The first thing they do is sit you down for a conversation you've avoided for 4 years. Your estate. You are 48. You have a wife, Junie, 2 kids, and a business worth more than every dollar your parents earned in their working lives. And if the truck meets a semi on Route 20 tomorrow, the estate tax comes due, the federal rate at the top is 40%, it is payable in cash, and your wealth is not cash. It's 6 plants and a linen route, which means Junie sells fast to whoever will close in 9 months. Everything you built gets liquidated at a discount to pay a tax bill, and the buyer is a fund exactly like the ones you refuse to invest in. That's when a family office stops being a status object and starts being plumbing, trusts, insurance to pay the tax, a buy-sell agreement, a valuation done annually so nobody guesses at the worst possible time. You sign the paperwork. It is the least exciting $212,500 you will ever spend. Level 6, $100 million. The office becomes yours. You sell 40% of the laundry group to a private equity firm out of Chicago for $61 million and keep operating control. Add the rest of the equity, the T-bills, the industrial buildings you bought instead of leasing, and a linen business in Kentucky, and the number in front of you is $104 million. And Wes and Ames, who did nothing wrong, are now charging you 0.85% of a much larger pile. That's $884,000 a year. Which is when the arithmetic quietly flips. Around $100 million is where a single-family office starts to make sense for an unromantic reason. A real SFO costs roughly $1 to $2 million a year to run, and annual operating expenses typically land between 1% and 3% of net worth. Below $100 million, you're paying full freight for a team to look after too little money. Above it, you're paying about what you already pay, except the team works only for you. So you build one, and the first surprise is how small it is. You hire 4 people, not 40, a chief investment officer, Priyanka Raut, who ran a pension book and is bored by anything with a story attached to it. A controller, Merrick Sable, whose whole job is knowing where every dollar is across 19 entities. A tax lead, because at this level tax is not an annual event, it is the largest expense line of your entire life, and it has to be engineered in advance. And one more, a woman named Dovie Alcaraz, whose actual job, the one everyone dances around at the interview, is to say no to the deals, to the cousins, to you at 11 p.m. when you're excited. But the real transformation is legal, because managing $100 million for other people would make you an investment advisor. You'd register with the SEC, disclosures, examinations, a public Form 8VD with your assets on it, searchable by anyone who has ever wanted something from you. You don't have to do any of that. Rule 202 at 11G1. The Family Office Exclusion, adopted June 22, 2011. Here's why it exists. Dodd-Frank rescinded the old private advisor exemption, the one that let any advisor with fewer than 15 clients skip registration, which is how family offices had operated for decades. When it died, the SEC had to carve them back out. 3 conditions. You advise only family clients, no outside money, ever. The office is wholly owned by family clients and controlled exclusively by family members or family entities. And you do not hold yourself out to the public as an investment advisor. Read that last one again. It is the whole personality of the thing. The price of the exemption is invisibility, no brand, no website, no pitch deck, no conference panel, no logo on the door. The moment you advertise, you are an advisor, and the whole structure collapses into a regulated entity with a filing cabinet full of obligations. You think about the vape shop, the nail salon, the pothole nobody fixed. The strip mall was never modesty, it was compliance. Level 7, $250 million. You stop paying fees and start charging them. Priyanka does the math in one slide, and it is not a complicated slide. A private equity fund charges 2% of your money every year plus 20% of the profits. In exchange, it buys unglamorous companies with recurring revenue and sticky customers, improves them, and sells them in 5 years. You have run unglamorous companies with recurring revenue for 22 years. You know what a bad linen contract smells like from across a parking lot? So why pay someone $2 and $20 to do a worse version of the thing you already do? You stop, and you start buying the companies yourself. An HVAC company in Illyria, $8 million a year, the founder is 68 and wants out in 90 days. You pay $9.4 million and put Odalise's old plant manager in as CEO. A pest control roll-up, 2 more laundries. A medical waste hauler nobody wanted because the trucks smell. None of it is exciting, all of it compounds, and the phone starts ringing the other direction. You spent 20 years being pitched. Now funds pitch you. You're the limited partner they want, the one with real money and no committee. And you learn the one thing money cannot buy, deal flow. You earn it by being the buyer who closes when he says he'll close, who doesn't retrade the price 3 days before signing, who wires on time. Brokers call you first, not because they like you, because you're easy. That's the whole edge. There is no other edge. And then, at exactly this level, your family shows up. Not a metaphor, your family. Junie's brother Corwin with a restaurant concept and a deck he made himself. Your cousin Dwayne, who needs a bridge, $180,000 just until the thing closes, and the thing has been about to close for 3 years. A nephew who wants to be a partner, not an employee, and doesn't know the difference. And they are not asking for money. They are asking for money as a proxy for whether you still love them, which is what makes it impossible. So Dovie Alcaraz takes the meetings, every one of them. She earns her entire annual salary in a single Thanksgiving because when the answer is no, it comes from the office, in writing, applying a written policy, and the family constitution says capital goes to businesses, not to birthdays. That's what the Constitution is for, a boring document that says who can request money, what qualifies as an investment versus a gift, how much gets distributed every year, and what happens when someone disagrees. It reads like an HOA bylaw, and it is the highest return thing you will ever sign, because the way large fortunes die is almost never a market. It's a family. 3 heirs, 1 company, no rules, and a lawsuit that lasts 11 years and consumes everything. Hal puts it plainly, returns are what you argue about at the office, he says. Governance is what decides whether there's an office in 30 years. And nobody gets capital just for being born. Level 8. $500 million. The most dangerous money in America. What you've built is not a safe thing. It's a loaded one. A family office is one of the least supervised large pools of capital in the country. No outside investors, no quarterly letter, no redemptions, no SEC examination, no compliance officer who can overrule you, no limited partner who can pull his money. Every one of those is a constraint, and every constraint is also a break. The exemption that protects you from being watched also removes everybody who might have stopped you. Chase Dunleavy is gone by now. Leveraged into a concentrated position that went the wrong way in 11 days. Margin called, liquidated, and now, at 51, selling commercial insurance. He is not a cautionary tale. He is a small one. Here is the large one. In 2013, a man named Bill Huang opened a family office. He'd run a hedge fund called Tiger Asia, shut down over insider trading accusations. Outside money was no longer an option. So he did what the structure allows, managed his own capital, and disappeared from the regulatory picture. He called it Archegos. And he did something clever, which is the word people use right up until the moment it becomes the other word. He didn't buy stocks. He bought total return swaps. The bank buys the stock and holds it, and Archegos gets the economics, the gains, the losses without ever owning the shares. Which meant Archegos never crossed the ownership thresholds that forced public disclosure. The positions were invisible even to the banks. He ran the same trade at Goldman, Morgan Stanley, Credit Suisse, Nomura, UBS, and none of them could see the others. Each thought it faced one client with a large position. None knew they were all holding the same position in the same few names for the same man. He ran roughly 8 times to 20 times leverage. He controlled about $100 billion of exposure. In late March of 2021, a few of those stocks dropped. The margin calls came, he couldn't meet them, and the banks, discovering each other in real time, ran for the same exit at the same moment. Archegos lost roughly $20 billion in days. Credit Suisse alone took $4.7 billion in losses. Nomura took about $2.85 billion. In November 2024, Bill Huang was sentenced to 18 years in prison. The structure did most of the work. Invisibility was the point of the design, and invisibility is exactly what made it impossible for anyone, including the people lending him the money, to see the whole book until it was on fire. Your $500 million does the opposite. Boring operating companies. Real cash flow from customers who need clean sheets whether or not the market is open. Leverage you could pay off out of a bad year's earnings. Nothing you own can be taken from you by a price move on a Tuesday, because nothing you own is priced on a Tuesday. You ask Hal once whether there's a number where it stops. He thinks about it longer than you expect. The goal was never to be unpoor, he says. It was to be unforceable. Nobody can force me to sell. Nobody can force me to answer. That's the whole thing, Wes. Everything else is decoration. There's a level nobody puts on the chart, and you only find it by accident. You're driving past the strip mall on a Tuesday in March. Vape shop, nail salon, same pothole, and it takes you a second to remember you own the lease on the whole row now. You bought it 4 years ago because the cap rate was reasonable and the tenants pay on time. Your office is in the same building. 4 employees. Priyanka, Merrick, the tax lead, and Dovey, who said no to 11 things last quarter and was right about 9 of them. There's still no sign on the door, and you finally understand what every level actually was. Not a number. A door, and the door was never the money. It was what the money was finally allowed to stop doing. At 0, it had to stop needing you in the building. At 250,000, it had to stop being income and start being capital. At 1 million, at 5 million, it had to stop being the last one to the table. At 100 million, it had to stop being visible. And at 500 million, it had to stop being forcible. Because nobody can make you sell something you don't have to sell. That's the whole ladder. Every rung was a subtraction. The laundry still runs. That's the part people don't want to hear. The trucks still leave at 4:15 in the morning. The nursing homes still want clean linen by 7, and somewhere in Sandusky a boiler is making a noise Odalise will have to deal with on Thursday. It never became glamorous. The number moved because a boring thing was allowed to compound for 22 years while you kept your hands off it. That's the entire mechanism. Hal is 78 now. He still doesn't offer anyone coffee, and the last thing you understand sitting in a strip mall between a vape shop and a nail salon, running $500 million for people who will never have to know what a linen route is that the family office was never the goal. It was just the name for the moment your money finally outgrew your permission.